Welcome back to our YouTube channel, The Book Digest. Today, we're diving into Way of the Turtle by Curtis Faith. It is the incredible inside story of one of the most famous experiments in financial history, and it all kicked off with one simple but profound question.
So let's really think about this for a second. Is being a great trader some kind of innate talent? Something you're just born with? Or is it a skill, something that can actually be taught and learned like any other craft? This exact question was at the heart of a huge debate, a real high-stakes argument between two absolute legends of the trading world.
On one side of the ring, you had Richard Dennis. This is a guy who famously turned just a few $100 into hundreds of millions. He was totally convinced that trading was a teachable skill. He was all in on nurture. And on the other side, his partner, William Eckhardt, a brilliant mathematician who argued from the nature side of things. He said, nope, you either have that special something or you don't. And they didn't just agree to disagree. They decided to settle it with a real-world experiment.
That's right. To prove his point, Richard Dennis basically put his money where his mouth was. They were going to find out, for good, if he could take ordinary people and literally manufacture elite traders from the ground up.
The plan itself was as simple as it was bold. They put out ads in the newspaper and got this incredibly diverse group of people together who had zero trading experience. I mean, the author of the book, Curtis Faith, was just 19 years old. And after a super short 2-week training course, Dennis handed them millions of dollars of his own money and told them to get to work. He even joked that he was going to grow traders just like they grow turtles at farms in Singapore, hence the name. So you're probably wondering, what was the secret sauce here? What in the world did they teach these turtles in just 2 weeks that could turn them into millionaires? Well, let's break down the actual system they used.
Okay, so the whole philosophy, the entire foundation, was built on this one concept called trend following. And what's so cool about this is that the system wasn't about predicting the future at all. It was about reacting to what was happening right now. The whole goal was just to spot a strong price movement, a trend, and then just ride the wave for as long as it would last.
And the rule for when to get in? It was shockingly simple. The turtles used something called a Donchian channel. Basically, if the price of something broke above its highest point in the last 20 days, they would buy. If it dropped below its 20-day low, they would sell. That's it. It was a purely mechanical rule, zero guesswork or gut feeling involved. But look, knowing when to get in is only half the battle. The real genius, the secret weapon of the system, was how they managed their risk. They use this concept called N, which is just a way of measuring how much a market tends to bounce around each day, its volatility. By basing their position size on N, they made sure that a trade in a wild market like crude oil carried the exact same amount of dollar risk as a trade in a sleepy market like corn. Every single bet was standardized. Pretty smart, right?
This right here is the heart and soul of the whole system. The turtles were drilled to take small losses immediately, without a second thought. But when a trade was actually making money, they did something that feels totally wrong. They bought more. It's a technique called pyramiding. This is how they squeezed every last drop of profit out of those rare monster trends that made up almost all of their gains.
Okay, so the rules were simple, the risk was perfectly managed. Sounds like a license to print money, doesn't it? Well, this is where the story gets really, really interesting, because it turns out the hardest part wasn't learning the system, it was dealing with your own brain while trying to trade it.
And this right here is the central mystery of the whole book. You've got this group of people, all taught the exact same mechanical system, trading with the same rules. So why did their results vary so much? I mean, some of them made absolute fortunes, while others just kind of fizzled out. What was the difference? The answer is in the brutal, emotional reality of what it's like to be a trend follower. You see, the system is designed to take loss after loss after loss, a whole stream of small, painful hits, all while you're waiting for that one home run. Can you imagine losing money almost every single day for weeks or even months and still having to trust the system and place the next trade? It's a massive, massive test of your psychological strength. To succeed, you had to conquer some powerful mental traps, like outcome bias. You make a perfect trade according to the rules, but it loses money, so you start thinking the rules are wrong. Or recency bias. After a dozen losses in a row, your brain starts screaming that you're never going to win again. And, of course, the sunk cost fallacy, just holding onto a losing trade because you've already lost so much on it. The turtles who made it big were the ones who could master these inner demons. So what kept the successful ones going through all that pain?
It was a deep understanding of one mathematical concept: expectancy. They knew deep down in their bones that even if they lost on, say, 60 or 70% of their trades, the system was still wildly profitable in the long run. Why? Because the average winning trade was just so much bigger than the average losing trade. That mathematical truth was their anchor in a sea of emotional chaos.
So, after all was said and done, after years of trading and generating over $100 million in profit, what was the final verdict on that original bet between Richard Dennis and William Eckhardt?
Well, the experiment showed that the truth was actually somewhere in the middle. You can absolutely teach someone the rules. You can teach them position sizing and risk management. You can even teach them the math behind expectancy. But what you can't teach is the raw discipline to follow those rules perfectly when things get tough. You can't teach someone the courage to endure loss after loss. That has to come from within. So, in a funny way, both Dennis and Eckhardt won the bet. Richard Dennis proved without a doubt that you can teach trading. He literally turned novices into millionaires. But William Eckhardt was also right because he understood that having the innate psychological grit to actually execute the plan day in and day out under extreme pressure, that's what truly separates the good from the great.
And really, that's the biggest lesson here. The story of the turtles isn't just about trading commodities. It's a powerful lesson about that huge, challenging gap that exists in almost everything we do. The gap between knowing the right thing to do and actually being able to do it. It's the difference between knowing the path and walking the path.
So I'll leave you with this question to chew on. In your own life, in your career, in your personal goals, where is your gap between knowing and doing? We all have one. And more importantly, what are you going to do to close it?